If I were starting investing today with no experience and no clue where to begin, this is exactly what I'd do. Not to get rich quickly, not to beat the market, just to build a calm, boring system that works over time. This isn't financial advice. It's a simple, educational breakdown of how investing works, explained in plain language. No hype, no promises, no predictions. Just the basics that matter if you're starting from zero. I'm going to do this in 3 parts. First, the mindset. What investing actually is and what it is not. Second, the setup. A beginner-friendly plan you can follow without constantly making decisions. Third, the traps. The common mistakes that quietly cost beginners years. Let's start with the core idea. Investing is not a test of intelligence. It's a test of consistency. When you're new, it's easy to think the whole game is picking the right thing, the right stock, the right crypto, the right moment, the right app, the right YouTuber, the right trick. But most of that is noise. The reality is, markets reward time, not excitement, and time only works for you if you can stay invested. Here's a useful way to think about it. Imagine you're building a small engine, not a sports car engine, not something that needs constant tuning, a simple, reliable engine that runs in the background. That's what a beginner investing system should feel like. Quiet, predictable, low maintenance. Because the biggest danger for a beginner isn't choosing something slightly imperfect. The biggest danger is choosing something that makes you anxious. If it makes you anxious, you'll check it too often. If you check it too often, you'll react too often. And if you react too often, you'll eventually sabotage yourself. That's why simple isn't a beginner compromise. It's the point. Now, before we talk about what to buy or where to invest, you need one mental shift. You are not trying to be right this week. You are trying to be consistent for years. If you're 18 to 30, your biggest advantage is time. Not because time guarantees anything in the short term, but because time gives compounding a chance to show up. Compounding is not a magic trick. It's a slow effect. Early on, it looks like nothing is happening, and that's where most people quit. In a moment, I'll show you a simple way to see compounding without getting lost in numbers. But first, let's make one thing very clear. Investing is not a straight line. You will have months where you're up. You will have months where you're down. You might have a year where it feels like nothing worked. That isn't failure. That's normal market behavior. A beginner mistake is to interpret normal movement as a sign you did something wrong. So they change the plan, and they change it again, and eventually they end up with a messy, emotional portfolio that they don't understand. A calm system avoids that. So what is the calm goal? The calm goal is own a small piece of many businesses, keep adding to it, and give it time. Not because businesses always win, not because it's guaranteed, but because broad ownership has historically been one of the most reasonable ways to participate in long-term growth without needing to be a stock picker. Now let's talk about what you actually control. You cannot control the market. You cannot control the headlines. You cannot control what happens next month, but you can control how much you invest, how regularly you invest, how diversified you are, how much you pay in fees, and whether you panic. Those controls matter more than most beginners realize. In a moment, I'll show you the simplest structure that uses those controls properly. But before we get there, let's clear up 2 misconceptions that confuse beginners. Misconception 1. I need a lot of money to start. You don't. You need a repeatable habit. Starting with a small amount is not pointless. It's practice. It's training your future self to behave correctly. Misconception 2. I should wait until I know more. Learning is good, but waiting for perfect certainty is usually just fear in a smarter outfit. You can learn while you do something small and controlled. The aim is not to sprint. It's to start walking in the right direction. In a moment, we'll expand this into a simple proof with a realistic example. But first, here's the core concept in one sentence. A beginner wins by making fewer decisions and staying invested longer. Now let's make it feel real. I'm going to use a simple math example, not to promise outcomes, but to show why the system matters more than the perfect pick. Imagine you invest £100 a month. That's not glamorous. It's not life-changing in a week. It's just a habit. Now imagine you do that for a year. You've invested £1,200. Here's the part beginners often miss. In year 1, the goal isn't growth. The goal is building the machine. Because if you can build the machine at £100 a month, you can usually increase it later as your income grows. Most people don't become wealthier because they found a secret. They become wealthier because their investing rate increases over time as their career and income grows. So in your 20s, the system is about two things. Start early enough that time can work. Build a habit you can scale later. Let's compare two realistic behaviors. Person A invests £100 a month, but stops whenever the market drops. They pause for 6 months here and there. They sell when they feel nervous. They buy back when things feel safe. Person B invests £100 a month and just keeps going. They don't watch every headline. They don't try to time entries. They treat it like a subscription they pay to their future self. Over a long period, Person B usually ends up with more invested time. Not necessarily more money contributed, more time. And time is the multiplier. Here's another way to see it. When markets drop, beginners often think, I'm losing money. But if you're investing monthly, a drop can mean everything I'm buying this month is cheaper. That's not a guarantee of profit. It's just a different interpretation. Instead of seeing volatility as personal failure, you see it as normal pricing movement while you accumulate. This is why automation matters. If you automate, you don't have to decide what to do in a scary month. The system continues, and you avoid the most common beginner pattern. Stop investing when it feels uncomfortable, then restart after the recovery has already happened. Now, before I show you the exact setup, there's one mistake that ruins this for most people. They turn investing into entertainment. They open the app like it's social media. They look at daily charts. They read hot takes. They join group chats. They chase what's next. That behavior creates emotional whiplash. And emotional whiplash creates poor decisions. If you want a calm investing life, you need a calm investing routine. The routine looks like this. Invest regularly, ignore most noise, review occasionally, and keep your costs low. Let's add one more realistic scenario, because this matters for the 18 to 30 range. If you're in that range, you're probably dealing with rent, travel, trying to build a career, maybe student loans, maybe unstable income, maybe switching jobs, maybe starting a business. So your plan cannot be fragile. It cannot require perfect months. It cannot require constant optimization. Your plan has to survive real life. That's why a simple, diversified approach tends to work well for beginners. It's hard to mess up, and that is not an insult. That's a feature. Now, before we move to the step-by-step setup, one more important point. The goal is not to avoid risk completely. The goal is to take the right kind of risk. There are two broad types of risk. One is market risk. Prices go up and down. You cannot eliminate that if you want growth. The other is behavior risk. You panic, you quit, you chase, you overtrade. You can eliminate a lot of that with a simple system. A good beginner plan is designed mostly to reduce behavior risk, because behavior risk is what destroys long-term results. In a moment, I'll show you the exact setup I'd use as a beginner. But first, here's a quick checklist to keep in your head. If your investing plan requires you to be calm every day, it's a bad plan. If it requires you to predict the future, it's a bad plan. If it requires you to check charts daily, it's a bad plan. A good plan works even when you're busy, tired, or distracted, because most of your 20s will be busy. Now let's build the setup. Here's the beginner-friendly system I'd use. Not tied to any one platform, not dependent on a specific country, just a simple structure you can adapt. Step 1. Build your base. Before investing, you want a small cash buffer. Not because cash beats investing, but because without a buffer, any unexpected bill forces you to sell investments at the wrong time. For a beginner, the buffer might be 1 month of essentials, then 2, then 3 over time. You don't need perfection on day 1. You just want to reduce the chance you'll be forced to sell. In a moment, I'll show you how the investing part works even if your buffer is small. But keep this principle. A small buffer protects your investments from your real life. Step 2. Choose a simple monthly amount. Pick an amount you can do even in a slightly bad month. If you pick an amount that only works in a perfect month, you'll quit. Start smaller than you think, then increase later. A useful rule is start with something that feels almost too easy. £25 a week, £50 a month, £100 a month, whatever is realistic. The goal is consistency, not intensity. Step 3. Invest in something broad and diversified. For beginners, the concept you're looking for is own a little bit of everything. You're not trying to find the next winner. You're trying to participate in overall growth without needing to guess. The simplest way to do that is usually a low-cost diversified fund that holds many companies. You'll often hear this described as an index fund or an ETF. You don't need to memorize the terms right now. The key is the idea: broad diversification, low fees, long time horizon. Step 4. Automate it. This is where beginners quietly win. Set an automatic transfer the day after you get paid, not at the end of the month. At the start, before life spends it for you. Automation does two things. It removes decision-making and it removes emotion. You shouldn't be deciding whether to invest every month. You should be running a system. Step 5. Set a review schedule. Not daily, not weekly, maybe once every 3 months, maybe twice a year. The review is not for panic. It's just to check, am I still investing regularly? Are fees still low? Has my income changed so I can increase my amount? Is my buffer still reasonable? That's it. Step 6. Have a bad month plan. This is important because bad months happen. A bad month plan might be reduce the contribution temporarily but don't sell, or pause contributions for 1 month but don't sell, or keep going as normal if you can and ignore the news. The plan is not never struggle. The plan is don't destroy the system during struggle. Now let's apply this to 2 quick beginner scenarios. Scenario 1. You have £100 total to start. You don't need to invest the full £100 immediately. You might keep £50 as buffer and invest £50, or invest £25 a week for a month. The exact split isn't the point. The point is starting the habit. Scenario 2. You can invest £200 a month. Great. Automate it. Then every 6 months ask, can I increase this by £25? If your income grows, your investing rate can grow. That's how the system scales. And notice what we didn't do. We didn't try to predict the market. We didn't try to pick winners. We didn't try to time entries. Because the beginner advantage is time and consistency, not precision. In a moment, I'll summarize this so you can remember it without notes. You don't need to rush this. Understanding the system is more important than timing it perfectly. If I were starting today, I would do 3 things. Build a small buffer so I'm not forced to sell, invest a simple amount automatically, and choose broad diversification so I don't need to guess. Then I'd give it time. That's how people quietly build wealth without needing to be experts. If you want the next step, the next video breaks down the maths of investing a very small amount, like £10 a week, and why consistency matters more than people think.